Recording in progress.
Hello everyone, welcome to our webinar on Indian banking sector. For today's webinar, we have Mr. Karthik Srinivasan, Senior Vice President and Group Head, Financial Sector Rating. We have Mr. Anil Gupta, Senior Vice President and Co-Group Head, Financial Sector Rating. Along with Anil, we have Mr. Ashish Choksi, Vice President and Sector Head for Financial Sector Rating. Participants are requested to put down their questions in the Q&A chat box post the presentation. We will address the questions. For now, I will hand over the presentation to Ashay.
Yeah, thank you, Saib. Good evening and welcome. Thanks for joining our webinar to update you all on our outlook on the banking sector. In our presentation today, we will discuss our key takeaways on the banking sector and our medium-term outlook. After this, we will move over to credit and deposit growth trends and our expectations before moving over to asset quality trends and our outlook on the same for financial year 24. Subsequently, we will shift our discussion to key drivers for profitability, followed with our estimates on the same. We will also discuss how public and private banks are placed in terms of their capital position and their near to medium-term capital requirements. And lastly, we will summarize our rating actions that have been taken by ICRA so far this year in the banking sector. Following our presentation, we will open the floor to questions. Also, please feel free to type in your questions in the chat box. We will be happy to take your questions once the presentation is over. So to begin with, we'll share our outlook on the sector. So with the impact of COVID-19 ebbing, the credit growth witnessed a strong rebound, which in our view should continue, given strong credit growth seen across sectors. And while the persistence of tight liquidity may slow credit growth in FY24, we still believe credit expansion should remain meaningfully strong. Besides this, asset quality pressures have already eased considerably, and headline metrics are now at their best level in close to a decade, which we expect to hold up in the foreseeable future. A combination of these factors is driving a strong earnings outlook for banks, which will also limit capital needs for the sector to maybe only a few banks. Against this backdrop and taking into account our expectations on a continued strong performance across various parameters, we have revised our outlook on the banking sector to positive. And in the coming slides, we will be discussing these at greater length, as well as our expectations on key metrics for the sector. Expanding on our positive outlook, we expect the banking sector GNPA and net NPA percentages to come close to nearly 4% and 1%, respectively, by March 24, which will be a decadal best. Capitalization and solvency profile has seen a relatively sharp improvement in recent years, though incrementally we still expect these to see some relative improvement from current levels. Sectoral ROA levels are also expected to cross the 1% mark, and we estimate this to be in the range of 1.2 to 1.3% in FY24, while return on equity will also see a healthy improvement. Moreover, these estimates do not take into account the events such as the HDFC Bank HDFC Limited merger or one-off transactions of NPA sales to ARCs, including NARCL, which could lead to some of these metrics being mildly better than what we have shared over here on this slide. If we look at the performance of public and private banks individually, both set of banks are expected to see an improvement and remain beneficiaries of strong growth and credit demand, easing asset quality challenges, while capital requirements in the medium term should be limited only to a few banks. While the outlook on the sector is positive, we have highlighted certain risks to our estimates over here on this slide. The first and foremost risk we see to our estimates is the higher than expected compression of spreads because of inability of banks to pass on the sharp rise in deposit costs. While we expect asset quality to improve, if for any reason the expected improvement in asset quality gets derailed either due to severe economic shocks leading to an increase in credit costs, there could be a risk to our estimates. Additionally, a one-time impact due to transitioning to Ind AS or a higher than expected spike in OPEX due to increased discretionary spending to expand the franchise, or for public banks, any pay scale or pension revision. These could be some factors which we see as a risk, as a key risk to our estimates. At this point, we'll take a pause and have our poll question roll out on the screen. We will take it will take a moment for it to appear on the screen.
Yeah, Ashay, is it visible?
Yeah.
Yeah. So, yeah. Yeah, we'll wait for a moment. We're still getting the responses. Okay, so we are done. I'll just end the poll and I'll share the results. Are the results visible, Ashay?
Yeah.
Okay. So clearly there is a divide between the two expectations. One is on the option one, which is margin compression and inability to pass on the higher cost of deposits in lending rates. And let's say related thing, like because of, let's say, if the rates are passed on to the borrowers, there could be asset quality issues. And apart from the global slowdown which we are witnessing. So basically, participants feels both the parameters are largely same, equally important. Yeah, Ashish, so we can move on.
Sure. So we'll now move on to the individual sections to share our outlook, and starting first with our outlook on credit and deposit growth.
Yeah, just a second. I'm just closing the poll. Yeah.
So during the last few years, the retail and agriculture segments drove growth. However, incrementally, credit growth remained strongest in the retail and service sectors. These two segments accounted for nearly 67% of the total credit expansion from April to November or mid-November 2022. Given the availability of bank funding at competitive rates vis-a-vis bonds or overseas borrowings, banking credit demand from the wholesale segment, including NBFCs, remained quite strong. The same factors also contributed to growth being strong even in the industrial segment, particularly the large industries, which was lagging the MSME segment in terms of overall growth. In the current financial year, the credit expansion was impressive at close to 10.6 trillion rupees till November 18, 2022, representing a year-on-year increase of growth of 17.6%. and surpassing previous year levels, and is now in absolute terms higher than the total credit expansion of 10.5 trillion for the whole year of fiscal 22. On the other hand, deposit growth has lagged, albeit on a larger base. Against this backdrop, liquidity conditions have tightened, with the daily average liquidity turning negative intermittently over the last few months, which we expect to continue at least in the foreseeable future. With public banks accounting for close to 2/3 of the total outstanding advances, overall system level growth remains dependent on growth trends of public banks. On the back of a much stronger capital position, low net NPA levels, and better earnings, public banks too could continue to push growth. This apart, the ability to mobilize deposits at competitive rates as well as lending at finer rates in the wholesale and corporate segments relative to private banks as well as the debt capital markets has supported the strong growth that we have seen in the corporate segment. As public banks have almost matched growth on a larger base, they have garnered a higher share of incremental advances this year, and public banks have gone ahead and increased their market share. And nevertheless, the larger private banks continue to witness a relative increase in their market share, while asset quality overhang for a few mid-sized banks continue to remain a drag on the growth for these banks. On a forward-looking basis, HDFC Bank and HDFC Limited merger will drive a one-time credit growth on a post-facto basis for the banking sector during next year. Incremental credit growth in FY23 is expected to remain at an all-time high in our view, in the range of 18 to 19 trillion for financial year 23, which will be significantly higher than the combined credit expansion of 15.2 trillion rupees for the COVID-impacted years of financial year 21 and 22 combined, and will be well ahead or higher than the previous high of 11.4 trillion during FY 2019. Further conditions are expected to remain conducive for growth momentum to continue into FY24 as well. And even though rising interest rates and tight liquidity conditions could lower year-on-year growth to somewhere in the range of 11 to 11.6%, as opposed to 15.2 to 16.1% for financial year 23. Nevertheless, we still believe that with an absolute credit expansion of 15 to 16 trillion, it should still remain supportive for banks to maintain reasonable growth. Incremental deposit growth in percentage terms, in our view, is expected to broadly remain stable. Though as it lacks credit growth, credit expansion is expected to be in the range of 1.2 to 1.3 times deposit accretion in FY23, which should narrow going forward to 1.1 to 1.2 times in FY24. Although with this, the system level credit deposit ratio is expected to rise back to pre-COVID levels. We will take a pause over here and have a poll question on your screen in a moment.
Yeah. So here we are asking about your outlook on FY24 credit growth vis-a-vis the financial year 23. So here what we are looking at is the incremental credit growth during financial year 24. Will the incremental credit be higher than the incremental credit growth which we are expected to see in the current financial year? Okay, I'll end the poll and I'll share the results. The results are quite interesting. So if you look at the results, broadly, market is evenly split. Seems like 41% are expecting that incremental credit, option number 1, in FY24 will be lower than FY23. whereas option number 3 is the like the most preferred option, where people are saying that the credit growth in financial year 24 will be even higher than what we are seeing in financial year 23. So basically, market which is expecting a sequential increase in incremental credit, and another half which is looking at a sequential decline in the incremental credit. So let's see how it pans out. Broadly, our view is that there could be a moderation in terms of incremental credit growth next year, given a very high number which we are looking into current financial year. Yeah, Ashay, we can move on.
So moving to the next section on asset quality and our outlook on the same. So COVID-19 increased gross NPA generation in FY22, which otherwise was expected to decline. The impact was to an extent less pronounced due to supportive measures like restructuring, which allowed banks to spread out the impact of the pandemic over multiple years. During H1 FY23, the annualized fresh NPA formation moderated down to almost a decadal low of 2.2%. Further slippages have also been granular, ensuring higher recoverability in a trend that we expect to continue. Corporate book slippages remained at about 20% of overall slippages in the first half of fiscal 23. And key corporate book slippages mainly include two names, that is the Future Group and Bajaj Hindustan, both of which were restructured accounts. Some mid-sized banks have also, in the private bank space, have witnessed episodic spike in slippages as well. Over and above the lower NPA generation, strong recoveries and upgrades kept net NPA generation low. And during H1 FY23, net slippages were considerably lower at 0.3 trillion rupees, as against gross slippages of 1.2 trillion for the banking sector.
We can complete this section, Ashay, on the asset quality.
Yeah, sure. In order to understand...
yeah, I'll move on.
Yeah. So, in order to understand system level stress, we have shown how GNPAs and standard restructured book has moved over the years for public and private banks on this slide. So while GNPA levels are still higher than what it was a decade ago, the stress including restructured book is lower. Some of this improvement was also led by high write-offs. Although on a forward-looking basis, this could moderate as most of the legacy NPAs have actually been written off. Nevertheless, system-level stress could continue to moderate from these levels by March 24. Besides this, a one-time transfer of stress assets under an ARC structure will also accelerate moderation in the system-level stress. The restructured book for the banking system will exit moratorium completely and entirely during FY24. Although we believe 60 to 70% has already exited moratorium so far, part of which is either sitting as part of overdue book for banks or slipped upon exit. While we have seen varying performance of the restructured book across banks, the retail unsecured segments has seen relatively higher slippages. In the near term, few banks are likely to be occupied with the restructured book given the elevated levels. However, incremental ask in terms of provision over and above what these banks hold, in our view, should remain manageable for most of these banks. Besides this, the overdue book has also seen a secular moderation across banks that report these numbers, and the residual book largely comprises of granular loans, pointing towards lower stress buildup for now, which remains a positive in our view. So moving to our asset quality estimates for FY23 and 24. So absolute GNPAs and net NPA levels should come down to multi-year lows, although on the back of strong advance growth and better asset quality levels, particularly in the corporate loan segment, we expect banking sector GNPA percentage to moderate to almost 4% by March 24, while net NPA percentage is estimated at close to 1.2%. A net NPA percentage for private banks is expected to see their lowest level since March 2015, while for public banks, led by a large recapitalization support over the years, could see its net NPA percentage reach its lowest level since September 2011. That being said, from an asset quality standpoint, we remain cautious on the impact of rising interest rates, inflationary or any kind of economic shock or disruption, which could be a source of downside risk on asset quality. Over here, we'll take a pause and we can have our next poll question.
Yeah, sure. So here we want to take your opinion on maybe the source on the segment, which will be the source for incremental stress on asset quality for next 2 to 3 years. So I hope the poll is visible. So maybe a couple of seconds more. Okay, so we have the responses. I'll end the poll and I'll share the screen. Okay, so here we have a consensus in terms of maybe the next source of stress, which most of the people believe that it will be the MSMEs, which will drive the stress for the banking sector. Corporates, yes, we agree, given the credit cycle or even internally when we look at the credit ratios, upgrade to downgrade ratios, numbers in terms of corporate asset quality have been holding up. So at least for next couple of years, this should hold well. MSMEs, yes, because of the rising rates, relatively lower pricing power in an inflationary environment, this could have an impact on their asset quality in the near term. So yes, thank you. I'll just go back to the presentation. Yeah, Shay, we'll move on to the next section.
So,
on profitability.
Coming to our estimates on profitability and our outlook on earnings. So both public and private banks witnessed a loan growth-led improvement in net interest income. As we have alluded in our growth expectations earlier, growth momentum is expected to continue over the medium term, which, along with the effect of a lagged deposit repricing, will support NII growth. While liability repricing will eventually catch up and spreads should narrow in FY24, a higher loan asset base will support NII, translating into continued improvement in operating profitability levels. Furthermore, we have seen lower credit provisions also, and this trend has also supported profitability for banks. As we have shown in the exhibits on this slide, lower credit costs have driven an improvement in internal capital generation for both public and private banks. While there was a relatively higher impact of MTM losses on public banks in the first quarter fiscal 23, this was offset by lower credit costs. We also noticed that while credit costs may be stabilizing at a certain manageable level, banks may begin to spend higher discretionary amounts towards franchise expansion, while public banks may also see a scale or wage revision related impact, which will remain monitorables for us. Credit costs for the banking system are expected to maintain a downward trajectory, even as upgrades and recoveries will be incrementally lower as aging provisions will largely remain limited. Besides this, large private banks are holding meaningfully large prudent provisions, that should largely take care of any incremental slippages and its associated credit costs, if any, in the future. Additionally, we also anticipate most banks to be able to manage stress arising out of the restructured book, and we do not expect any major surge in provisions on account of the same. Given the low net NPA levels, together with an expected decline in gross NPA generation, credit costs will remain at lower levels for banks. This, together with strong growth, could improve profitability to their best levels for private banks in FY24, and perhaps the best for public banks in more than a decade. The improving earning profile is also expected to keep incremental capital requirements limited for most banks. While during the first half of this fiscal, we saw limited repricing of deposits in relation to lending rates, the one-year term deposit spiked in the run-up to the December policy hike. We expect this trend to continue in the near term as well. The sharp increase in deposit rates has the potential to pressure operating profitability. And if banks are unable to adequately pass on these higher costs of funds to their customers, it could impact their operating level, profitability levels. However, despite these challenges, given the credit growth environment, we expect banks to maintain reasonable NIMs, translating into an improved ROA trajectory. And we expect the banking sector to close ROA at an ROA of 1.2 to 1.3% by FY24, as against 0.9 to 1% for fiscal 23 and 0.9% for FY22. Before moving to the next section, we can have our next poll question.
Yeah, sure. I'm launching a poll basically where we are expecting that what is the opinion of the participants in terms of peaking out of the deposit rates. By when do you expect the deposit rates to peak out? The questions should come on your screen now. Is it visible?
Yeah.
Okay, so I'll end the poll again. Some sort of a divided view, but at least a large portion believes that it's going to be the H1 of, let's say, the financial year 2024, when the deposit rates will possibly peak out. So maybe around 70% people believe Q1 and Q2 is the period when the deposit rates shall peak out. Yeah. Back to you, Ashay.
Yeah. So coming to our estimates on capital and capital requirements of banks. So capital levels of all public banks are higher than the regulatory Tier 1 capital requirement of 9.5%. Further, better earning prospects make public banks well positioned to grow without requiring any capital. Also, with better capital and provision coverage, solvency profile has also improved, which in our view is expected to continue into FY24 as well. Besides this, public banks have also raised a much higher quantum of AT1 bonds amounting to close to 195 billion rupees, which is even higher than the amount due for call option for this and next year combined. Moreover, the stronger performance of public banks has improved their capital raising prospects as well, which should, in our view, limit their dependence on GOI for any capital in the foreseeable future. Coming to private banks, large private banks are strongly placed on capital, and most of these banks are expected to recall their AT1 bonds of rupees 181 billion in FY23, which is much higher than the fresh issuances expected at rupees 30 billion. given their capital and healthy earning profile. However, in the private bank space, we anticipate few banks may still need to raise growth capital. And some of these banks are highlighted here in the exhibit. And these banks may need to raise capital given their relatively weaker solvency levels. Among these, though, Yes Bank's capital base should broadly meet its medium-term requirements. And despite this, we expect private banks should end 24 with Tier 1 at comfortable levels between 13.9 to 14.4% by the end of 24. On this slide, we have also summarized our broad views on the capital requirements of public sector banks. One, as we discussed earlier, that given the strong performance and improvement in internal capital generation, we expect public banks to be self-sufficient, and FY24 could be possibly the second consecutive year without any capital budgeted for public banks. In fact, if our earning estimates hold out for FY24, then in a best case profitability scenario, the dividend payout by public banks may almost meet the coupon servicing on the recap bonds, assuming a 30% dividend payout rate. Key points to look out for in the foreseeable future would be the sovereign guarantees on security receipts issued by NARCL, classification of the large public banks as DSIBs, which in our view will require some additional capital or support, as well as the ongoing privatization of IDBI, which by itself will set the tone for similar actions, if any, in the future. At this point, we can have our last poll question, Anil.
Sure, I'll launch the poll. Here we are asking about the transitioning of Indian banks to expected loss regime and implementation of Ind AS by RBI. So what is the expectation of the participants? When you think it is going to be launched, made applicable? Is it the next financial year, next to next, or maybe you see a longer time horizon for that? So we'll give a couple of more seconds. Okay, so we are done. So here we have a sort of a consensus. I'll share the results. So largely, it's like the financial year 25, when most of the people expect that possibly the regulator will possibly consider the banks to shift to Ind AS. And yes, rightfully so, because they're in much better position in terms of their P&L as well as in their balance sheet to maybe absorb any one-time impact because of the transitioning if it were to happen. So yes, they can transition in a much more smoother way now. So yeah, over to you, Ashay.
Yeah. So coming to our coverage on the banking sector and some recent rating actions. So we rate 11 out of 13 public banks, including IDBI Bank, and 11 out of 18 private banks. Given the improvement in performance of public banks and the expected sustainability of the same, public banks have dominated positive rating action since financial year 22. And so far this year, in H1 FY23, ratings on the positive side include rating upgrades of Indian Overseas Bank, Bank of Maharashtra. In the private banking space, we have upgraded the ratings for Yes Bank and Karur. The outlook on the ratings on Central Bank and IDBI were also revised to positive. As for now, among the banks mentioned on this slide, only the ratings on Bandhan Bank remains on negative outlook. Looking ahead, we expect the overall performance of various players to be stable or on an improving trend, which should also remain supportive from a credit rating perspective as well. So with this, we'll end our presentation, and we'll be happy to take up any questions that you may have. Looking ahead, we expect.
Thank you, Ashay. Participants are requested to put down their questions in the Q&A section, and the questions will be addressed by Mr. Karthik Srinivasan and Anil Gupta. We have 2 questions on the chat box, 3 questions now.
Yeah, the first question I'll take, Karthik. So it says there is a consensus among analysts that microfinance sector is a basic industry, is a cyclical industry. And what is your view over the longer term? Will it be cyclical as the CV or the real estate industry? So that is the first question. And second is the probability of an industry-wide 10% credit cost event. So basically, see, cyclicality is one event, one thing, and disruption is the another thing. So unlike a real estate industry and maybe a CV industry where we believe that there could be demand or supply-led events which lead to a cyclicality in the industry, microfinance industries, the credit cost events are more driven by disruptions, which could lead to the maybe disruptions in the cash flow of the borrowers. So we have seen the events like maybe demonetization, the COVID, the Andhra Pradesh crisis, floods, or let's say the elections. Basically, these are the events which we can't term as cyclicality, but more of a disruptive events which basically impact either the cash flow of the borrowers or their discipline in terms of servicing of the EMIs. So the attaching a probability of a 10% credit cost event, so it's again very difficult. But yes, we have seen that whenever such disruptions do happen, there is a significant impact in terms of credit cost, and possibly the frequency of these events could not be predicted. And assuming maybe one sort of an event over a 5-year cycle may be not correct also, or like it may be so difficult to predict these disruptions. Yeah, Karthik, anything else from your side? Karthik, you're not audible.
What I'm saying is we need to be cognizant of the fact that unlike the past, across industries, cycles are becoming shorter. So a banking sector and an MFI sector is not immune to this. All cycles are getting shorter. So to that extent, and these shortening of cycles are being driven by new market dynamics, disruptions in the market, and other reasons. So to that extent, one just needs to be mindful of that aspect. RBI's norms on limiting LTVs and all, in a sense, we can say that these are measures to ensure that the underlying borrower is not overburdened, but finally it has to be used by both the borrower as well as the lender to ensure that both of them remain solvent by the time the loan is to be repaid.
Yeah, Karthik. So another question is about will this decade see M&A and cause the consolidation in the industry, keeping neo banks in mind?
Financial sector is like a couple of other sectors are seeing a lot of disruption. We would be seeing a lot of new business models come into play. We've already seen the rise of fintechs, and within a short span of time, quite a bit of heightened activity levels out here. So that's something which is likely to continue. But in what form and would it really happen? I think we need to wait and watch on that front. But clearly, one can say that there would be consolidation in this industry. Will it be banks and NBFCs, banks and fintechs, or anything else? I guess that would depend on how the parties concerned see synergies amongst themselves for the transaction and are in a position to culminate the whole process.
Yeah, the second question is somewhat related, Karthik. So it talks about account aggregator system and about that one big bank with lower credit cost to have all the data, and will it impact the interest yields for housing finance and small finance banks, HFCs and SFBs, and who will be the winner and loser? So you're right. Data is going to be a very important driver. We have seen a lot of shift happening by way of like database decisions, development of scorecards, and digitally underwriting the loan. So once you have more data availability and a bank with the higher or a better ability to underwrite, possibly could see further gain in terms of market share. Yes, I'll agree with that view. Karthik, anything else you would like to add?
I guess data does bring with itself a lot of advantages, and whoever is in a position to use data well would be able to reap the benefits. But clearly, from a lending community, liability side would remain the key. To pushing the cost of lending down can only happen if you are also in a position to mobilize funds at a much finer rates. So while account aggregator stuff will definitely be good in terms of pulling down the yields, but that is subject to are the entities or the main players in a position to cut down their own cost of funds.
Yeah. The next question is, how should we look at the macroeconomic global factors like USA recession and their impact on the Indian banking? Looking at perspective of slowdown in IT sector, also your take on Credit Suisse issue. We do caveat that yes, though the domestic setup looks attractive in terms of the outlook on the banks, whether it is related to the growth, margins, or in terms of the asset quality. But yes, we are caveating it with the few factors which we have given in our presentation also, that any disruptions or severe economic disruptions which can lead to maybe increase in the slippages, because at the end, like, we have significant exports also, and sizable portion of our industry is also dependent on the export. So if there is a export slowdown, it could have an impact on the asset quality for some of the sectors. On the IT sector, maybe a slowdown, yes, that could be one of the concerns, but at the same time, I think the rupee depreciation has given some cushion to them. The pay hikes and the wage hike remains good. Per se, not anything a matter of concern as of now. On the Credit Suisse issue, I think we rate any one entity of the group, the Indian entity, which you can refer to our rating rationale on our website, ICRA.in, on this subject. Next question is on what will be the closely tracked monitorables going forward from your side on the banking sector. So yes, here we have given out our risk factors, which we are closely tracking, because these will be the factors which will determine how the performance is going to be, how much compression or ROA contraction happens because of maybe the funding cost, asset quality issues, or let's say regulatory changes related to Ind AS or provisioning norms. So these are certain things which we will track. We do believe that these could be taken care in the near term, next couple of years, but maybe long term, how these things pan out is something which we have to see. But at least for next 1 to 2 years, we believe that it is going to be a good scenario in terms of growth, margins, and the credit provisions. One of the another question is, can e-rupee be industry disruptor? So It's a very initial days, only maybe a couple of days where it has passed. But see, if the adoption of e-rupees picks up considerably, possibly what can happen is, because once a user converts the deposit which it has in its bank account into a digital currency in its wallet, then the deposit accretion for the banking system does get impacted. So it's like a currency in circulation, the similar impact which increase in currency with public or currency in circulation will have an impact on a bank deposit. So if the currency in circulation increases, bank deposits, the accretion slows down. So if the adoption is higher, then there could be moderation in terms of bank deposit, but it will be not something maybe in a one shot. It could be gradual. But I think the convenience which other form of digital payments like UPI and other wallet offer, maybe we have to see how this adoption evolves. What probabilities and risk are there for banks who handle ruble INR payments for India-Russia corridor for being sanctioned? So I'll share my views, Karthik, just in case any additional. So when this event started, we contacted our rated entities to check in terms of any exposure to maybe the entities based out of Russia or with ownership of Russian companies or Russian government, and sort of a trade flow. So what we broadly understood, it's not very material at an overall level, plus at the individual bank level. Yes, subsequently the INR trade, ruble trade settlement has started, but I think it's per se not a credit risk which will maybe fall onto the Indian banks. Karthik, anything maybe you want to supplement this? It's not a credit which the banks are giving out to the Russian entities or Russian counterparts.
This stage is really difficult to quantify anything. The overall volumes are still fairly limited. We probably need to assess this as really volumes pick up, and there are other transactions where we do hear that international trade could happen in rupees. So maybe once that picks up, one would possibly need to just reassess the situation.
There is another question on, will account aggregator will make business of affordable housing and high yield MSME loans unviable for HFCs and NBFCs as bank with lower cost of funds and more data. So consolidation, yes, we answered this, that yes, if data is it's made widely available, yes, the competition can increase and could lead to lower cost of funds for these borrowers from these entities. So this will also result into maybe more consolidation among the sector. But again, the market itself will also grow, right? So the number of borrowers, number of customers in the overall pie will increase. Customers who are currently borrowing from maybe affordable housing finance company, NBFC or HFC will migrate to banks. New customers will possibly come to NBFCs, affordable housing finance companies, establish some sort of a credit history, and maybe then again move to banks. So this cycle, the deepening of financial penetration will improve. Borrowers will graduate from a high cost lender to a medium cost and then a low cost lender. So that stage of evolution will keep on happening for borrowers as well as lending institutions. Yeah, another question is, what could be the reasons for deposit growth in PSBs relative to private banks? Also, are private banks going to see further fall in market share as PSBs improve in terms of credit and capital position? So Yeah, so see, in this cycle, maybe last couple of months, the competition really, if you look at the aggressive competition in terms of deposit chasing, that has really started only in November, December. So prior to November, December, the retail deposit rates were not hiked so much as the repo rate or the money market rates went up. So yes, what we are expecting is with now liquidity being almost negligible in the banking system, now banks will have to incrementally rely on maybe fresh deposit mobilization, and they will compete with each other to garner the more deposits from within the banking system or increase their share. And this trend will possibly continue for next couple of quarters, till a time when you possibly see a contraction in terms of credit demand, or maybe the deposit rates becoming maybe unsustainable and not making sense to maybe grow. Private banks are going to see a fall in market share. There could be here and there, but as we know that per se, the government intention is also to consolidate the public sector banking space, divesting few of the public banks. So maybe in the long term, it could be like that share for the private sector possibly should improve much higher from what currently it is at around 36% odd. So we do believe that maybe over the next decade, the market share should be very different, despite this maybe couple of quarters, maybe anomaly. Yeah, Karthik, anything else you want to add?
No, you're right in the sense that, given the improvement in the capital profile of public sector banks, they have become more competitive. So to that extent, the gains that the private sector banks had in the last couple of years, that pace would definitely go down. But beyond that, it depends on how each of the segment really plays out. There is one question specific to importance of port sector. I mean, given it's part of a larger infrastructure, and infrastructure is a focus and a thrust area for the government, the sector does remain important. But in case there are any specific queries on that, maybe you could just write to us separately. We will have somebody from our infrastructure team address those points separately to you.
Another question is on what's your view on Indian infrastructure lending? Will public sector banks have higher exposure as private banks, and NBFCs seem risk averse to this sector? So again, I think there has been a lot of learning, which not only the public sector banks have maybe gone through in the last decade, but even the system per se, whether it is the concessioning authority, the government, the appraising authority, or maybe the project evaluators and maybe the bidders, all of them have gone through a learning cycle. And I think risk aversion will be there, but once maybe a more certainty is available onto the cash flow, which is visible from a infrastructure lending or the asset, I think the lenders should be more than willing to take up such assets which are operating and having a very predictable cash flows. So I think the aversion will be largely to the projects where there is a lot of uncertainty attached, either in terms of traffic or in terms of completion risk. Once these risks are mitigated and you have a clearly established cash flow trajectory, I think the appetite remains strong, not only from the public banks, but also other lenders, including private banks. Do you have the data on what's the average credit cost for mudra loans in the last few years. So again, see, mudra loans are, I don't know, but these are basically there are three segments: Shishu, Kishore, and I think Ashay, one more is there, right? Shishu, Kishore, and so these are the three categories where, depending on the ticket size, the mudra, which is the refinancing institutions, refinance the loans of various lenders. So let's say all the microfinance loans will be eligible under mudra. A bank one does not wants to get it refinanced, so it will not qualify, classify, get it refinanced through mudra, though it is a microfinance loan which is sitting in its own books. Right now, similarly, a commercial vehicle loan could qualify for a mudra loan. So we can't specifically say that the mudra segment, which possibly gets reported in the annual reports of, let's say, any particular bank or a mudra as a refinancing institution, are the only loans where possibly you are seeing the NPA. So it's a class of a loan. Microfinance loans, let's say, you have seen a credit cost of even less than 1% or 2% during the good times, and the bad times we have seen 10% credit cost also, right? CVs, we see very good years and very bad years also. So per se, attaching a credit cost maybe or maybe coloring the mudra loans as a bad loans, I'll really not have a view on this.
I think mudra is used in the banking parlance as far wider range and for loans which are qualified as mudra loans, and that kind of data is not really tracked. So basically, there's no consolidated credit cost estimates or numbers of mudra loans given or sanctioned and disbursed by banks. At least we don't have it.
Yeah, Sahib, I think we are done with the questions in the chat box.
Sure. Yeah. We'll just wait a couple of minutes in case anyone has any additional question. If not, then we can end this webinar. We'll just wait for a few seconds.
Sure.
In case anyone has any questions, they can put down in the chat box or reach out to us and we might be able to connect. I guess there is one question on the chat box.
Yeah, so question is how ICRA looks at the housing finance segment in the current scenario, as sector faced a lot of downturn due to slippages of the LAP loans and also few important names and all. So yes, so slippages were there. We understand a lot of LAP goes to the MSME segment as a business loan where you take a loan against your property. And because we know that MSMEs were also the ones which got impacted severely during COVID, and despite those ECLGS and moratorium, the impact was quite severe. So yes, they have seen impact because of the COVID, but at the same time, because these are secured loans secured by a property, so the LGDs per se have been relatively lower. And Karthik, anything on housing finance segment right now in the current
segment per se is doing okay. We did have some challenges on the LAP portfolio. Delinquency numbers have increased for the home loan segment as well as compared to others, but they're still very much under control given the thrust for affordable housing and housing for all plans still being extended. This is a segment which we see shall continue to grow. And unlike the Western markets, Indian lenders still lay a far more greater emphasis on analyzing the eligibility and the serviceability of the loan by the borrower before extending. So notwithstanding some of the stress periods for some of the HFCs, we think this segment should continue to do well at a broader level.
Yeah. any red flags expected owing to higher growth in consumer and personal loans? Yes, we have been concerned about this high growth. Now, the challenge is how do you segregate the growth because the penetration has been improving, the ease of availing the credit has been improving, and the underwriting, the ability to take an underwriting decision has been improving. So do you treat this growth as a maybe a improved penetration, or you treat it as a over leverage? So that is a dilemma which always is there when you look at such high growth numbers, that are the borrowers over leveraging, or are the is the penetration improving? Karthik, anything? But whatever we discuss, we see banks are saying that they are largely relying on their internal pool of customers while they are giving out such loans. The banks have their cash flow visibility with them before they are lending out unsecured. Yeah, Karthik.
I think it is still a fairly limited portfolio of consumer loans for banks. So at a portfolio level, we don't see too much of a risk. But point taken, any segment, if it grows extraordinarily fast, as in any lending business, you will see the pains, a couple of years down the line, or a couple of quarters down the line. At this point in time, given a fairly diversified portfolio, we don't see the risk. But that's something that one is sort of keeping an eye on to see how things really play out on that front. There's one question on impact on fee income of banks due to neobanks. Neobanks are a relatively new concept from an Indian point of view. There again, regulations are changing. The interplay between neobanks, what products they can offer, how they can, how the conventional commercial banks and neobanks can coexist and help each other. Regulations are evolving to an extent. So a bit early to comment on that. But from a broader fee income point of view, given the fact that credit has started picking up for the commercial banks, fee income to an extent is sort of coming back on track, which was possibly on a weaker side over the last couple of years, practically because of negligible growth happening in the system. There's a question on MSMEs. With MSMEs getting impacted, would the banking sector face tough time if recession got major? As in any economy, if you get into a recession, the economy suffers, and the financial sector also would need to share some of the burden on that part. So the similar case would be true as far as the Indian market is also concerned. Possibly it's some time away, because while our growth numbers may be lower than what we anticipate, but it's still significantly higher than the global numbers. So to that extent, possibly recession is some time away. So, and with signs of economy picking up, at least this question doesn't seem to be an immediate concern as of now. But at a broader holistic level, if an economy was to get into recession, the impact would definitely get felt on the lender's balance sheet and P&L as well. There's one question on bank Nifty levels. We are rating analysts, so possibly we'll stay away from commenting on equity values.
One question is, will recalling large part of 81 bonds will add to liquidity pressures in the future, as tightening process is still going on the economy? So recall is due once every 5 years on these bonds, and as per our estimate, total bonds which will be outstanding will not be more than 1.2 lakh crores. So when we are looking at maybe 1.2 lakh crores of 81 bonds on a total deposit of maybe 175 lakh odd crores, one, it is a very small portion of the total funding, and another is maybe not entire 81 bonds are repayable in a particular year. So the maturities are staggered. So recalling will per se not have any visible impact on the liquidity for these banks. New age banking impacting old banks? Reduction in NII possible or not?
Not really. One needs to understand that the new age banks and the old banks or the existing large commercial banks are possibly operating in slightly different segments. If we were to the focus is slightly different. So to that extent, it would not really have a direct impact. But yes, given that the new age banks possibly start off with a better technology, or given the pace at which technology is changing, I guess the how well a customer is serviced, that may turn out to be the key, and the impact of that on financials like NII and others would only be visible over a period of time. At the current stage, we are looking at a scenario where the new age banks offers higher rates on deposits, and at the same time they're also operating predominantly at the higher range as far as the asset class is concerned, whereas the established banks most of them offer lower rates on deposits, and they play across the lending spectrum on the asset side.
Thank you so much, Karthik. I guess we had a really interesting and interactive session today. So on this note, we'd like to thank all the panel members, Mr. Karthik, Anil, and Nashay. And most importantly, I would like to thank all the attendees to participate today and to make this webinar a success. We look forward for your support and continuous participation on our upcoming webinars. Till then, thank you so much. We would like to end the webinar now.
Yeah, thank you very much. Thank you everyone for participating.
you.